Imagine a life where every dollar you earn stays in your pocket, where your financial freedom isn't hindered by overwhelming tax burdens. Welcome to Tax-Free Living, how to legally pay zero tax. In this journey, we'll explore the secrets hidden within U.S. tax laws, uncover little-known legal strategies, and inspire you to take control of your finances. Before we begin, a quick legal disclaimer. The strategies discussed in this audiobook are intended for educational purposes only and should not be construed as professional tax or legal advice. Always consult a qualified expert before making any significant decisions. Welcome to Chapter 1, The Tax-Free Mindset. I'm not here to sugarcoat the realities of our financial struggles. If you're paying too much in taxes and feeling the pinch every month, you're not alone. Today, we're going to break down a mindset that can literally change the way you manage your money. This isn't about wishful thinking. It's about concrete, actionable steps that can transform your financial life starting now. Let's cut to the chase. Every single dollar you earn is hard-earned, and when a big chunk of it goes straight to taxes, you're left wondering, where did it all go? I remember meeting a friend a few years back. Let's call him Mike, who was frustrated because despite working overtime and picking up extra gigs, his bank account barely budged. He'd always thought that paying taxes was just part of life, an unavoidable sacrifice. But then he learned to question that narrative. Mike started digging into the tax code, asking, am I really making the most of what I earn? That simple question sparked a journey that transformed his finances. So, how do you start thinking like Mike? First, understand that your tax situation isn't a punishment. It's a puzzle waiting to be solved. Begin by taking an honest look at your income and expenses. List every source of revenue and every deductible expense you can find. I know this sounds tedious, but think of it as your financial health check. If you're not tracking your money, you're essentially leaving clues for the IRS to pick up on without you knowing. Mike discovered that by categorizing his expenses and income, he could spot patterns that allowed him to claim deductions he never knew existed. Now, let's talk specifics. One of the first actionable steps you can take is to automate your record keeping. Use a simple spreadsheet or a budgeting app that lets you tag expenses. When you categorize every dollar spent, from business supplies to charitable donations, you're building a paper trail that can pay off during tax season. For instance, Mike started using a basic app that reminded him to record each expense. Within 6 months, he was amazed to find he had over $2,000 in deductible expenses that he'd completely overlooked before. That's money you can legally keep instead of handing it over to the government. Another critical step is to educate yourself about deductions. And I'm not talking about vague, generic advice. I'm referring to specific, actionable tips. Did you know that if you work from home, you might be eligible for a home office deduction? It's not a free pass, but if you're using a part of your home exclusively for work, you can deduct a portion of your rent, utilities, and even internet costs. Mike, who runs his own small consulting business, was able to save nearly $1,500 in taxes last year just by calculating the correct percentage of his home used for work. That's real money added back into his pocket. I also want you to challenge the assumption that tax savings are only for the wealthy or those with complicated financial portfolios. In reality, even modest income earners can benefit from these strategies. Take the case of Lisa, a single mom working 2 jobs. She was struggling to make ends meet and thought tax deductions were only for big corporations. Once she started keeping meticulous records of every deductible expense, from childcare costs to mileage for work, she found herself eligible for credits that reduced her tax bill by nearly 30%. That relief meant more money for her children's education and everyday needs. Now, let's address a common pain point: the fear of making mistakes. The tax code is intimidating, and it's easy to feel overwhelmed by the complexity. But here's the truth. You don't have to become a tax expert overnight. Start small. Invest time in understanding 1 or 2 key areas that affect your situation the most. For many, that's learning about standard deductions, charitable contributions, and home office expenses. Once you have that foundation, you can gradually add more strategies into your financial toolkit. I want you to remember that this isn't just about saving money. It's about reclaiming control over your life. Every time you take a step to understand your tax obligations, you're taking a stand against the feeling of helplessness. I've heard from countless individuals who, after they started applying these principles, began to see not just a healthier bank account, but a healthier relationship with money. They felt empowered, motivated, and ready to tackle bigger financial goals. A critical milestone in this journey is to set up a simple system to review your finances on a regular basis. Whether it's once a month or every quarter, make it a habit to sit down and review your income, expenses, and potential deductions. This isn't about obsessing over every penny. It's about making informed decisions. Mike, for example, now sets aside an hour every month to review his spending. This habit not only helps him stay on top of his finances, but also gives him a sense of accomplishment. Over time, these small actions add up to significant savings. Lastly, let's talk about mindset shifts. Many of us have been conditioned to see taxes as an unavoidable burden. But what if you flip that script? Instead of viewing tax payments as a loss, consider them as a part of a larger strategy. A strategy where every decision you make can lead to more freedom and less financial stress. This isn't just theory. It's a practical approach that people like Mike and Lisa have embraced with real results. Remember, the journey to a tax-free mindset isn't about a quick fix or a magic bullet. It's about consistent, deliberate action. And the best part is, once you start applying these strategies, you'll notice that financial freedom isn't just a dream. It becomes a reality. So, take a deep breath, start small, and let each milestone propel you to greater financial empowerment. Now, let's move forward together, one step at a time, toward a future where you keep more of what you earn. This is your journey, and it starts right here, right now. Chapter 2. The U.S. Tax Landscape Unveiled. Welcome back. Now that we've set our sights on achieving tax-free living, it's time to roll up our sleeves and get intimate with the beast itself, the U.S. tax system. Don't worry, I'm here to guide you through this maze with real-life stories and actionable tips that have transformed tax burdens into tax benefits. The tax code, not just for the elite. Let's start with a story. Meet Jane, a freelance graphic designer from Austin, Texas. Jane used to dread tax season, viewing it as a time when the government would swoop in and take a hefty chunk of her hard-earned money. That was until she decided to confront the tax code head-on. By dedicating just a few hours each month to understand the basics, Jane discovered deductions and credits she never knew existed. The result? She legally reduced her taxable income by over $15,000 in 1 year. Jane's story isn't unique. It's a testament to the power of knowledge. Actionable tip number 1, dedicate time to understand tax basics. Set aside time regularly to familiarize yourself with tax concepts. Resources like the IRS website and reputable financial blogs can be invaluable. Knowledge is power, especially when it comes to taxes. Income tax, the core of the matter. At its heart, the U.S. tax system is progressive, meaning the more you earn, the higher your tax rate. But here's the kicker. Not all income is created equal. Take Mike, for example. Mike is a software engineer in San Francisco. He noticed that his colleague who earned a similar salary was taking home more pay. The difference? His colleague was contributing pre-tax dollars to a health savings account, HSA, and a 401k. By redirecting $5,000 to his HSA and $19,500 to his 401k, Mike's colleague reduced his taxable income by $24,500, leading to significant tax savings. Actionable tip number 2, maximize pre-tax contributions. If your employer offers retirement plans like a 401k, or if you're eligible for an HSA, contribute as much as you can. These contributions lower your taxable income and grow tax-free over time. Deductions versus credits. Know the difference. Understanding the distinction between deductions and credits is crucial. Deductions reduce your taxable income, while credits reduce your tax liability dollar for dollar. Consider Sarah, a teacher in Ohio. She spent $500 out of pocket on classroom supplies. She learned about the educator expense deduction, allowing her to deduct up to $250 of such expenses. Additionally, by taking courses to enhance her teaching skills, she qualified for the Lifetime Learning Credit, which provided a credit of 20% of her tuition expenses up to $2,000. Actionable tip number 3, research occupation-specific deductions and credits. Many professions have specific deductions and credits. Teachers, for instance, can benefit from the educator expense deduction and the lifetime learning credit. The standard deduction versus itemizing. Choose wisely. Every taxpayer faces a choice. Take the standard deduction or itemized deductions. The standard deduction amounts are adjusted annually for inflation. For 2024, the standard deduction is $14,600 for single filers and $29,200 for married couples filing jointly. Let's look at Tom and Lisa, a married couple from Florida. They had significant medical expenses due to unforeseen health issues. Their total itemized deductions, including medical expenses exceeding 7.5% of their adjusted gross income, mortgage interest, and charitable contributions, amounted to $32,000. By itemizing, they reduced their taxable income more than the standard deduction would have allowed. Actionable tip number 4. Calculate both standard and itemized deductions. Always calculate your potential itemized deductions and compare them to the standard deduction. Choose the option that offers the greater tax benefit. Self-employment, a double-edged sword. Being your own boss has its perks, but it also comes with tax responsibilities. Self-employed individuals pay both the employer and employee portions of Social Security and Medicare taxes, totaling 15.3%. However, there are silver linings. Emma, a freelance writer in New York, discovered she could deduct the employer equivalent portion of her self-employment tax, health insurance premiums, and even a portion of her rent through the home office deduction. Actionable tip number 5. Leverage self-employment deductions. If you're self-employed, familiarize yourself with deductions like the home office deduction, health insurance premiums, and retirement plan contributions. These can substantially reduce your taxable income. Capital gains. Timing is everything. Investing can be a pathway to wealth, but it's essential to understand how capital gains are taxed. Short-term capital gains, assets held for less than a year, are taxed as ordinary income, while long-term gains benefit from reduced tax rates. David, an investor from Chicago, made the mistake of selling stocks he'd held for just under a year, resulting in a higher tax bill. Had he waited a few more weeks to qualify for long-term capital gains rates, he could have saved thousands. Actionable tip number 6. Hold investments for over a year. Whenever possible, aim to hold investments for more than a year to benefit from lower long-term capital gains tax rates. State taxes. Don't overlook them. While federal taxes get most of the attention, state taxes can also take a significant bite out of your income. Some states have no income tax, while others have rates exceeding 10%. Consider Alex, who had the flexibility to work remotely. By relocating from California to Texas, Alex eliminated his state income tax liability, resulting in substantial annual savings. Actionable tip number 7. Evaluate state tax implications. If you have the flexibility to choose your state of residence, consider the state tax implications. Moving to a state with no income tax can lead to significant savings. Tax planning, not just a year-end activity. Proactive tax planning can lead to substantial savings. Regularly reviewing your financial situation allows you to make adjustments before it's too late. Sophia, a marketing consultant, schedules quarterly meetings with her accountant. This proactive approach allowed her to implement strategies like income shifting and tax loss harvesting in real time, optimizing her tax position throughout the year. Actionable tip number 8. Schedule regular tax check-ins. Don't wait until tax season to think about taxes. Regularly review your financial situation and adjust your strategies as needed. The power of professional guidance. While self-education is invaluable, there's no substitute for professional advice tailored to your unique situation. After years of DIY tax filing, Mark, a small business owner, decided to consult a tax professional. The result? He uncovered missed deductions and credits that saved him over $10,000. Actionable tip number 9. Consult a tax professional. Especially as your financial situation becomes more complex, seeking professional guidance can uncover opportunities and ensure compliance. Welcome to Chapter 3, The Power of Legal Loopholes. In this chapter, we're going to break down in plain language how you can legally minimize your tax bill. I still remember when I first started getting serious about my finances. I was shocked to learn that a significant portion of my income was disappearing each year, simply because I wasn't taking full advantage of the tax code. One friend of mine, Dave, practically had a sticky note on his fridge with a checklist of simple tax strategies. He wasn't trying to cheat the system. He was simply using legal loopholes designed to reward good financial behavior. That approach saved him thousands of dollars every year aside, money that he then reinvested into his future. Let's start with a straightforward example: the home office deduction. If you work from home, even if it's just a few hours a day, you may qualify to deduct a portion of your home expenses. The key is to designate a specific area exclusively for work. For many people, this can translate into a deduction ranging from $500 to $1,000 a year. It might not sound like much, but over time, it adds up. And it's a perfect example of how the tax code rewards you for keeping your work and personal lives separate. Another powerful tool is your retirement accounts. When you contribute to a 401k or an IRA, the money you put in is not counted as taxable income for that year. For example, if you contribute $19,500 to your 401k and you're in the 24% tax bracket, that's an immediate tax saving of roughly $4,680. Over the years, not only do you reduce your taxable income, but your investments grow tax deferred until you withdraw them. This dual benefit is a cornerstone of smart financial planning. Health savings accounts, or HSAs, deserve a special mention too. If you're on a high-deductible health plan, you can contribute up to $3,650 for an individual or $7,300 for a family each year. These contributions are pre-tax, the earnings grow tax-free, and withdrawals for qualified medical expenses are also tax-free. That's a triple tax advantage right there, a hidden gem for anyone who qualifies. Now, let's talk about itemizing deductions. Many people take the standard deduction without realizing they might benefit more from itemizing. Take charitable donations, for instance. One client, Sarah, started bunching her donations by giving double the amount every other year. This strategy allowed her to surpass the standard deduction threshold in those years, effectively letting her claim a larger deduction and saving her thousands in taxes over time. For the self-employed or those with side gigs, business expenses are a goldmine. Every legitimate expense, from a new computer to monthly software subscriptions or even a dedicated phone line, can be deducted from your income. I once worked with an entrepreneur who, by keeping meticulous records of his business expenses, managed to reduce his taxable income by nearly 4%. That's money he didn't have to pay taxes on, and money that stayed in his pocket to reinvest in his business. Depreciation is another powerful tool, especially if you own rental properties. Even though your property might be appreciating in market value, the IRS allows you to deduct a portion of the property's cost each year as a non-cash expense. For instance, if you have a rental property valued at $200,000, you might be able to deduct around $7,000 per year for depreciation. Let's say your rental generates $20,000 in income annually. Without deductions, you'd owe taxes on the full $20,000 at your marginal rate. But with $7,000 in depreciation, your taxable income drops to $13,000. At a 24% tax rate, that's a tax saving of roughly $1,680 each year. Over a decade, those savings can easily exceed $16,000, and that's just from one property. Timing your income and deductions is another actionable strategy. Sometimes it makes sense to shift income to a year when your tax bracket is lower. For example, if you're nearing retirement, you might choose to defer bonuses or delay receiving certain payments until your overall income drops. This kind of strategic timing can result in substantial tax savings over the long run. Now, let's address a topic that can sound intimidating: offshore accounts. The term offshore often raises red flags, but when used legally, setting up an offshore retirement plan or bank account is an established strategy. The key is to fully comply with U.S. reporting requirements. Some savvy investors use these accounts as part of a broader international strategy to manage assets. It's not about hiding money. It's about taking advantage of legal structures and international tax treaties that allow for efficient cross-border investments. However, this is an area where you must work with professionals who specialize in international tax law. Let's put this all into perspective with a real-life case study. I once had a client, let's call him Mark, who was new to tax planning. He felt overwhelmed by the complexity of the tax code, but he took one small step. He met with a tax advisor who patiently explained the basics of legal loopholes. Mark learned about the benefits of the home office deduction, maximizing retirement contributions, and carefully tracking every business expense. Over the course of a single tax year, Mark saved nearly $10,000 in taxes. He reinvested those savings into his business and his retirement accounts. This isn't a magic trick. It's simply smart planning and taking advantage of the incentives built into our tax system. The beauty of these legal loopholes is that they're not underhanded schemes. They're incentives intentionally embedded in the tax code to promote behavior that benefits both individuals and society. For instance, the government wants you to save for retirement, to donate to charity, and to invest in your business. By understanding and utilizing these opportunities, you're not just avoiding taxes, you're making a proactive decision to improve your financial health. So, what's the first step? Education. Begin by reading IRS publications, reputable financial blogs, or even books by authors who break down these complex ideas into simple, actionable rules. Next, maintain meticulous records. A well-organized system of tracking expenses, contributions, and investments is essential. Finally, consult with a tax professional who understands your unique financial situation. Personalized advice can make a huge difference in how effectively you apply these strategies. In summary, legal loopholes are powerful tools in your financial toolkit. They allow you to reduce your taxable income, preserve more of your hard-earned money, and reinvest it into building your wealth. Think of it as fine-tuning your financial engine. Just as a well-maintained car runs more efficiently, your finances will perform better when you actively manage your tax obligations using these legal strategies. By taking small, consistent steps, such as optimizing your deductions, timing your income, and leveraging business expenses, you can significantly lower your tax burden over time. It's about working smarter, not harder, and using the system to your advantage. Every dollar you save on taxes is a dollar that can work for you in achieving financial freedom. That's the power of legal loopholes. With careful planning, record keeping, and professional guidance, you can navigate the tax code effectively and keep more of your money for your future. Take a deep breath, review your financial situation, and start implementing these strategies. Your future self will thank you. Now, let's get ready to build on these ideas in the next chapter, where we explore even more advanced tactics to further enhance your financial freedom. Chapter 4, Building a Strong Financial Foundation. All right, let's cut to the chase. Building a strong financial foundation isn't about quick fixes or get-rich-quick schemes. It's about laying down solid, actionable steps that you can follow day in and day out. This chapter isn't here to sugarcoat things. I'm talking real-life tips that have helped people like you and me turn our financial lives around. First off, let's tackle budgeting. If you don't know where your money is going, you're essentially flying blind. I remember when I first got serious about my finances, I started tracking every single dollar. I used a simple spreadsheet and even a basic budgeting app, and the results were eye-opening. In just 1 month, I discovered that I was spending over $300 on coffee and dining out. Once I cut back, I redirected that money into savings and investments. My advice? Write down every expense, no matter how small, for at least a month. You'll be surprised by how many unnecessary expenses you uncover. Now, let's talk about building an emergency fund. Life is unpredictable. Whether it's an unexpected car repair or a medical bill, you need a safety net. A good rule of thumb is to have at least 3 to 6 months worth of living expenses tucked away. I know it sounds like a lot, but think about it. If you earn $3,000 a month, setting aside just $500 a month in a high-yield savings account will get you to that goal in about 6 months. It's not about being perfect. It's about being prepared. And trust me, that feeling of security is priceless. Moving on to debt management, a pain point for many. High-interest debt can eat away at your financial progress. I once worked with a client, let's call him Mark, who was drowning in credit card debt with rates above 20%. We mapped out a plan where he focused on paying off the highest interest cards first while making minimum payments on the rest. Within a year, Mark had slashed his debt by nearly 40%. The key is to stay disciplined. Every extra dollar you can put toward the debt with the highest interest is a dollar saved from future interest payments. Now, let's shift gears and discuss investing. Not in some complicated stocks or risky ventures, but in instruments that offer tax advantages. For starters, think about your 401k or an IRA. These accounts aren't just retirement vehicles. They're powerful tools for reducing your taxable income. I remember when I first started, I maxed out my 401k contributions each year. The tax savings were immediate, and watching that balance grow year after year was incredibly motivating. Even if you're just starting, contributing even a small percentage of your income consistently can have a huge impact over time. Another practical tip is to automate your finances. Automation is your friend when building a financial foundation. Set up automatic transfers from your checking account to your savings and investment accounts. This removes the temptation to spend what you might otherwise save. One listener, Sarah, shared her story with me. She set up an automatic transfer of $200 every month into her Roth IRA. Over the span of 5 years, that little habit turned into over $12,000 in contributions without her having to think twice about it. Let's also cover the importance of living below your means. This isn't a call to austerity. It's a call to intentional living. One strategy that worked for me was the pay yourself first rule. Before I even considered paying any bills or splurging on non-essentials, I would transfer a fixed amount into my savings. It sounds simple, but this one rule changed everything. A friend of mine, Mike, went from living paycheck to having a solid savings cushion by just automating a 10% savings rate from every paycheck. It wasn't magic. It was discipline and consistency. Now, I want to address a common stumbling block, the mindset that you have to sacrifice enjoyment today for a secure tomorrow. That's a myth. Building a strong financial foundation means making smart choices without feeling like you're missing out. For instance, if you're tempted to splurge on the latest gadget, ask yourself, is this purchase going to move me closer to my financial goals? It might help to set clear milestones, like saving for a vacation fund or a down payment on a home, and then celebrate those achievements. When I hit my first milestone of saving $10,000, I treated myself to a modest getaway. Not a lavish vacation, but something that marked the progress I'd made. In the end, every action counts. It's about building habits that, over time, compound into significant financial benefits. There are no shortcuts here, just a series of small, smart decisions that add up. Whether you're tracking every cent, automating your savings, or slashing through high-interest debt, remember that consistency is key. So here's the takeaway. Start small, stay disciplined, and make your money work for you. Financial freedom isn't a distant dream. It's a journey that begins with one step at a time. Take these actionable tips, apply them to your life, and watch as your financial foundation grows stronger every day. And remember, this advice is based on real experiences and numbers. There's no one-size-fits-all solution, but by tailoring these strategies to your personal situation, you can build a robust financial base that supports every goal you have for your future. Stay committed, keep learning, and let your financial journey be a testament to the power of smart, intentional living. This is your blueprint for building a solid financial foundation, simple, direct, and built on real, actionable steps. Now, let's move forward and put these strategies into action. Welcome to Chapter 5, Tax Strategies for Beginners. In this chapter, we're cutting through the clutter to give you clear, actionable tips that will help you legally reduce your taxable income. I'm not here to deliver vague advice or endless jargon. I'm here to share real strategies that worked for real people, and they can work for you too. Let's start with one of the most overlooked strategies, knowing when to itemize versus taking the standard deduction. Most people choose the standard deduction because it's simple. But sometimes, if you track your expenses carefully, you can actually save more by itemizing. Take Dave, for example. Last year, Dave spent a few extra minutes each month organizing his receipts for charitable donations, medical expenses, and even those small miscellaneous costs he thought weren't important. By the end of the year, his itemized deductions exceeded the standard deduction by 15%, which saved him over $1,000 on his tax bill. The takeaway here is simple. Invest a little time in keeping track of your expenses. It might feel tedious, but when you see those savings add up, it's worth every minute. Another critical tip is to maximize your contributions to tax-advantaged accounts. If you have a 401k or an IRA, make it a priority to contribute up to the legal limit. I remember Sarah, a teacher from Ohio, who was initially hesitant to increase her retirement contributions because it felt like you're tightening your belt now for a benefit later. However, after learning that every extra dollar she contributed was not only growing tax deferred, but also lowering her taxable income, Sarah changed her approach. In 1 year, by boosting her contributions, she reduced her taxable income by nearly $8,000. This simple shift didn't just secure her future, it also provided immediate tax relief. For you, this means reviewing your retirement accounts and ensuring you're not leaving any tax benefits on the table. For those of you with a side hustle or who are self-employed, work-related expenses can be a goldmine. You're allowed to deduct costs for items like office supplies, part of your home expenses if you have a dedicated workspace, and even travel expenses related to your business. I recall working with Michael, a small business owner who ran an online consultancy. Michael meticulously documented every expense, from his monthly internet bill to the cost of attending industry conferences. By doing so, he was able to reduce his taxable income by a significant margin, often deducting around 20% of his revenue as legitimate business expenses. Michael's approach was straightforward. If it's necessary for your business, keep the receipts and document it. This is one of the easiest ways to ensure you're not overpaying on taxes. Now let's talk about tax credits. Unlike deductions, which reduce the amount of your income that gets taxed, credits reduce your tax bill directly. One standout example is the Earned Income Tax Credit. I once met John, a modest income earner, who initially thought these credits were too good to be true. After a brief consultation with a tax advisor, John learned he qualified for several credits that nearly wiped out his tax bill. His experience taught me, and now you, that it's crucial to double-check your eligibility for credits every year. Sometimes it can feel like a small detail, but those credits can lead to substantial savings. Another effective strategy is timing your income and expenses. This might sound a bit complex, but it's really about planning ahead. If you can control when you receive income or when you pay certain deductible expenses, you can shift your tax burden from 1 year to the next. For example, I recall a freelance writer who decided to prepay some of her business expenses before the year ended. By doing so, she managed to lower her taxable income significantly, which resulted in a much lower tax bill when it was time to file. This strategy requires a bit of foresight, but it's one of the best ways to manage your cash flow and tax liability effectively. One more piece of advice: don't be afraid to use tax preparation software or to consult a professional, at least until you feel confident navigating the tax code on your own. I remember when I first started handling my own taxes, I made a couple of avoidable mistakes simply because I wasn't familiar with the process. Investing a little money in quality software or professional advice not only saved me time, but also helped me uncover deductions and credits I'd never known existed. Think of it as a small investment in your financial literacy that pays off every tax season. Lastly, remember that tax planning is not a one-time event. It's an ongoing process. Your financial situation changes, tax laws evolve, and strategies that worked last year might need to be adjusted this year. Set a reminder to review your tax strategy annually. A simple yearly review can help you catch changes and fine-tune your approach, ensuring that you're always prepared and not leaving any money on the table. Chapter 6: Advanced Tactics for the Savvy. Welcome back, savvy listeners. In this chapter, we're diving deep into the advanced tactics that will transform your tax strategy from basic to brilliant. Now, if you've been following along so far, you already know the fundamentals. Today, we're going further, cutting through the noise with straightforward, no-nonsense advice that you can start applying immediately. Let's break down these advanced tactics with real-life examples, actionable tips, and some stories from folks who took control of their financial futures. First, let's talk about the power of income shifting. Income shifting isn't as complicated as it sounds. The idea is simple. Strategically move income to lower tax brackets legally. For instance, consider the case of a small business owner named Mark from Ohio. Mark was paying close to 35% on his personal income tax. By restructuring his business as an S corporation and paying himself a reasonable salary while taking additional distributions, he managed to reduce his overall tax rate by nearly 10 percentage points. This isn't magic. It's understanding that different forms of income are taxed differently, and you can plan accordingly. Now let's get practical. If you're self-employed or own a small business, review your current compensation structure. Ask yourself, am I paying too much in payroll taxes? Would it be smarter to reclassify some income as distributions? Sit down with your accountant and run the numbers. It might sound like a lot of paperwork, but the savings could mean thousands of dollars a year in additional cash flow. And remember, every dollar saved can be reinvested in your future. Another powerful tactic is the strategic use of retirement accounts. For many beginners, the idea of setting up a 401k or an IRA seems basic, but here's where the advanced twist comes in. Instead of merely contributing the minimum, consider maximizing your contributions to benefit from both the tax deferral and the compound growth over time. Let me share the story of Lisa from Denver. Lisa, a mid-career professional, began maxing out her 401k contributions once she understood the long-term benefits. Within 5 years, her tax savings on contributions and the compounded returns on her investments allowed her to build an emergency fund that covered nearly a year's worth of expenses. That's the kind of milestone that not only prepares you for the future, but also reduces your taxable income each year. Next, let's explore the world of health savings accounts, or HSAs. HSAs are one of the most underutilized tools in the tax planning arsenal. They offer a triple tax advantage. Contributions are tax deductible, the money grows tax-free, and withdrawals for qualified medical expenses are tax-free as well. Picture this. John, a 42-year-old teacher, decided to switch to a high-deductible health plan to open up an HSA. Over a decade, by contributing the maximum allowed and investing the funds wisely, John accumulated an HSA balance that not only covered his medical expenses, but also functioned as an additional retirement savings vehicle. If you haven't already, it's time to explore if an HSA fits into your overall tax strategy. Let's shift gears now to the world of capital gains and losses. One tactic that many overlook is tax loss harvesting. This technique involves selling off losing investments to offset the gains from your winners. Consider the example of Sarah, a tech professional from San Francisco. Sarah had a diverse portfolio with both soaring gains and some disappointing losses. By strategically selling her underperforming assets at the right time, she was able to offset nearly 80% of her capital gains. This wasn't about gambling on the market. It was a calculated move to reduce her tax bill and then reinvest in stronger opportunities. For you, the takeaway is clear. Keep a close eye on your portfolio. When you notice a position that isn't working out, don't be afraid to pull the trigger on a sale if it means reducing your tax liability. Another advanced tactic is leveraging charitable contributions. We all want to give back, and with the right planning, you can do so while reducing your taxable income. Instead of simply donating cash, consider donating appreciated stocks or other assets. This allows you to bypass capital gains taxes on the appreciation and still take a charitable deduction for the full market value. Let me tell you about David, a retired engineer from New York. David had a sizable portfolio of stocks that had performed exceptionally well over the years. By donating shares to his favorite charity, he not only made a meaningful impact, but also avoided paying up to 15% in capital gains taxes on the appreciated value. For those of you with significant investments, this is a double win. Help others while smartly managing your tax obligations. Now, let's talk about the benefits of tax-efficient investing. This tactic is about structuring your portfolio so that the tax impact is minimized. For example, placing bonds in tax-deferred accounts like an IRA or 401k and keeping stocks in taxable accounts can optimize your overall tax situation. A well-known strategy, popularized by financial experts like Mr. Money Mustache, is to focus on low-turnover index funds. These funds generate fewer taxable events because there's less buying and selling happening within the fund. Over time, this small adjustment can lead to substantial tax savings, which adds up as you continue to invest year after year. I know it sounds overwhelming, but here's a straightforward tip. Review your current portfolio with a critical eye. Are you holding investments that generate excessive taxable income? If so, consider rebalancing into more tax-efficient alternatives. This isn't about taking risks. You're simply fine-tuning your strategy to ensure that more of your money stays invested and working for you. For those ready to step it up even further, there's an advanced strategy known as in-kind transfers. This involves transferring assets between accounts without triggering a taxable event. Let's take the case of Emily from Texas. Emily wanted to shift a portion of her taxable investment portfolio into a tax-advantaged account. Instead of selling and repurchasing, which would have generated capital gains, she worked with her financial institution to execute an in-kind transfer. The result? Zero tax hit, all while repositioning her assets to be more tax efficient. It's a strategy that requires some coordination with your financial advisors, but it's well worth exploring if you're looking to optimize your tax plan. I want to emphasize that these tactics aren't about finding loopholes or skating on the edge of legality. They are all perfectly legal strategies that require diligence, careful planning, and a willingness to dig into the details. The common pain point many of you face is the feeling of being overwhelmed by tax complexity. I've been there too, and I know the frustration of watching hard-earned money vanish each year. But with these advanced tactics, you take control. You're not just reacting to tax laws, you're actively working with them to secure your financial future. Now, before we wrap up this chapter, let's recap with a few actionable steps you can implement right away. 1. Review your income structure. Determine if shifting some income from payroll to distributions could reduce your overall tax rate. 2. Max out your retirement contributions. Calculate how much you can contribute annually to your 401k or IRA and see how that aligns with your long-term financial goals. 3. Open or fully utilize an HSA if you're eligible. Look into high-deductible health plans that let you take advantage of these powerful accounts. 4. Conduct a portfolio review. Identify any underperforming investments for potential tax loss harvesting. 5. Consider donating appreciated assets instead of cash if you're charitably inclined. Reach out to a tax advisor to understand how to structure these donations efficiently. 6. Evaluate your investment holdings for tax efficiency. Consult with your financial planner about the possibility of in-kind transfers to avoid unnecessary tax events. Welcome to Chapter 7, Offshore Accounts, Legally Diversifying Your Portfolio. If you're tired of seeing your hard-earned money dwindle away under heavy tax burdens, you're in the right place. Today, we're cutting through the noise and giving you straightforward, actionable tips on how to legally leverage offshore accounts to diversify your portfolio and reduce your tax liabilities. Let's get one thing straight. Offshore accounts aren't about hiding money from the IRS. They're a legitimate financial tool that, when used correctly, can help you manage your wealth more efficiently. Think of it as another avenue in your financial toolkit, a tool that can help you protect and grow your assets if you follow the rules. Now, I know that the idea of moving money overseas can sound intimidating. I remember when I first heard about offshore accounts, I was overwhelmed by legal jargon and warnings of potential pitfalls. But here's the truth. With a clear plan and proper guidance, offshore accounts can be a safe, strategic way to lower your tax bill. Let's break it down with a real-life example. My friend Tom, a savvy investor from Atlanta, decided to move a portion of his portfolio offshore after realizing that his domestic investments were being heavily taxed. Tom wasn't trying to evade taxes. He simply wanted to diversify his assets and take advantage of favorable banking conditions in jurisdictions like the Cayman Islands. By working with a reputable financial advisor and following all legal requirements, Tom was able to lower his effective tax rate by nearly 5 percentage points, saving him thousands of dollars each year. So, how can you replicate this kind of success? Let's go over some specific, actionable steps. First, determine your objective. Ask yourself, are you looking to lower your tax burden, protect your assets, or both? This clarity will help you decide how much money you want to move offshore and what kind of account suits your needs. Step 1 is research. Identify jurisdictions that are known for stable financial systems and favorable regulations for U.S. investors. Look into countries like Singapore, Switzerland, or even Bermuda. Each of these places has a reputation for strong regulatory frameworks and robust banking systems. Avoid jurisdictions that are widely known as tax havens with opaque practices. They can bring more trouble than benefit. Next, consult with professionals. I can't stress this enough. Before taking any action, talk to a tax attorney or a certified financial planner who specializes in international finance. They'll help you understand the complexities of U.S. laws regarding offshore accounts, including the necessity of filing forms like the F-bar and adhering to FATCA requirements. I once worked with a client, Sarah from Ohio, who moved a part of her business income to an offshore account in Belize. With her advisor's help, she navigated the paperwork and compliance issues, ultimately saving around $20,000 in taxes over 2 years. Sarah's experience shows that proper guidance can turn a daunting process into a manageable, rewarding strategy. Now, let's talk money management. When setting up your offshore account, make sure you understand all the fees involved. I've seen cases where banks charge as much as $150 a month in maintenance fees. Compare that with other banks that might charge only $50 a month. Over a year, that fee difference can add up to about $1,200, a sum that, if saved, could be reinvested and help your wealth grow even more. Always ask for a detailed breakdown of fees up front, and don't hesitate to shop around until you find a bank that offers transparency and fairness. Another crucial tip is to maintain meticulous records. Every transaction, every fee, and every bit of income must be documented. This isn't just good practice, it's a legal requirement. The IRS demands full disclosure of your offshore accounts if your total balance exceeds $10,000 at any point during the year. I recall one instance where a client, overwhelmed by the paperwork, nearly missed a filing deadline. That oversight could have resulted in steep penalties. To avoid that, set up a system, whether it's a dedicated spreadsheet or software, that tracks every detail of your offshore account activity. It might sound tedious, but trust me, this level of organization will pay off in the long run. One common pain point many of you might have is the fear of running afoul of the law. Let me be clear. If you follow the guidelines and remain transparent with the IRS, you're in the clear. There's no secret formula to dodge taxes illegally. What we're talking about here is legal diversification. It's about using the options available within the law to manage your assets smarter. I once met a couple from Texas who were skeptical about offshore accounts until they saw the numbers. They had been frustrated with low returns on traditional savings. After moving a portion of their assets offshore, they experienced a 30% increase in their net income over 3 years, thanks to a lower effective tax rate. Their story is proof that when executed properly, offshore strategies can make a significant impact on your financial health. Let's get into the nuts and bolts of how to set this up. First, decide on the purpose of your offshore account. Is it for tax reduction, asset protection, or diversification? Once that's clear, compile a list of reputable banks and jurisdictions that match your criteria. Then, contact a few financial advisors to get multiple opinions. Look for advisors with a track record in international finance. Don't settle for someone who's only handled domestic cases. After choosing a bank, gather all necessary documents. This will likely include identification, proof of address, and financial statements. Be prepared for a rigorous verification process. I've seen many investors get frustrated when their account opening is delayed because of missing paperwork. Avoid that pitfall by double-checking every document before submission. Once your account is open, set up a schedule for regular reviews. Financial landscapes change, and what works today might not be optimal tomorrow. I recommend quarterly meetings with your advisor to assess your offshore strategy. These reviews will help you stay proactive, adjusting your approach as needed to maximize benefits and remain compliant with evolving laws. Before I wrap up, let me leave you with a final piece of advice. Offshore accounts, when used correctly, are a tool, not a free pass to avoid paying taxes altogether. They're part of a broader strategy that includes domestic financial planning, smart investments, and ongoing compliance. Remember, every step you take should be with the intention of building a secure financial future, not merely chasing quick tax breaks. Welcome to Chapter 8, Navigating Legal Challenges and Compliance. In this chapter, we're cutting through the noise and getting straight to the facts. No sugarcoating, no filler. If you're serious about building a tax-free lifestyle, you need to understand the rules, face the challenges head-on, and turn potential obstacles into stepping stones for success. Let's start by talking about one of the most common nightmares for anyone trying to optimize their tax situation: the audit. I remember a client, let's call him Mark, who ran a small business and had spent years meticulously building his financial records. Mark always believed that staying organized was his secret weapon. But even he wasn't immune to an IRS audit. When the notice arrived, his heart sank. However, because Mark had invested in a reliable accounting software and maintained detailed records, the audit turned into an opportunity. Instead of scrambling, he presented every document with precision, and the audit concluded with 0 adjustments. Mark's story shows us one crucial lesson: invest in your record keeping. Spend 30 minutes every month updating your files. It's a small investment of time that could save you thousands of dollars and endless stress later on. Now, let's get practical. The first actionable tip I want to share is simple: digitize, digitize, digitize. Physical copies of documents can be lost, damaged, or simply misplaced. Use a secure cloud storage service to back up every receipt, every contract, and every correspondence related to your finances. I once worked with a friend, Lisa, who suffered a flood in her home office. All her important documents were ruined. After that ordeal, she switched to a digital system, and since then, she's been able to access her records from anywhere. In our world of uncertainty, this isn't just smart, it's essential. One common compliance pitfall many new tax strategists face is ignoring the fine print when it comes to offshore accounts. Offshore accounts can be a fantastic tool for diversifying your assets and legally minimizing your tax burden, but only if handled correctly. For example, the U.S. requires that any offshore accounts be reported through the FBAR, Foreign Bank Account Reporting, and in many cases, additional IRS forms. I recall a small business owner who thought that because his offshore investments were small potatoes, they wouldn't trigger any attention. Unfortunately, he missed his FBAR deadline, and the resulting penalty was a harsh $10,000 hit to his savings. The takeaway? Never assume that a small oversight won't have big consequences. Mark your calendar, set reminders, and double-check every form you submit. Your future self will thank you for that diligence. Another major challenge is the sheer complexity of tax regulations. Many of us have faced the frustration of trying to decode the jargon-filled instructions on IRS forms. To combat this, I recommend finding a reliable tax advisor who speaks your language, someone who can break down the complexities into actionable steps. I once had a client who was overwhelmed by the idea of filing taxes for his multi-state business operations. After a few consultation sessions with a seasoned tax professional, he was not only able to streamline his filings, but also identified deductions he'd overlooked for years. The cost? A modest fee of around $600, but the payoff was a reduction in tax liability by over $8,000 in that year alone. It's all about investing wisely in expertise when the stakes are high. Now, let's talk about audits again, but this time, focus on how to avoid unnecessary legal headaches. One of the best strategies is to never wait until the last minute to file your returns or update your records. Being proactive can often mean the difference between a smooth process and a costly, stressful scramble. For instance, I recall another case where a client named Jim maintained a quarterly review of his financial statements. When discrepancies did appear, he fixed them immediately instead of hoping they'd resolve themselves. As a result, when he was randomly selected for a review, everything was in order. His quarterly review wasn't just a habit, it was a safeguard against potential pitfalls. A critical, often overlooked aspect of compliance is communication with your financial institutions and advisors. It might seem trivial, but maintaining a transparent line of communication can preempt many issues before they escalate. Let's say you're using offshore accounts to legally reduce your taxable income. Regularly check in with both your tax advisor and your bank to ensure that every transaction is accurately reported. I recall an instance when a client experienced a minor error in his bank's reporting system, which could have led to complications. Because he maintained open communication with his bank and notified his advisor immediately, the issue was resolved in days rather than months. Now, I want to address a very real pain point: the fear of legal repercussions. It's natural to worry about making a mistake that could cost you more than just money. Think fines, penalties, or even criminal charges. But here's the reality. Most issues can be avoided with disciplined, methodical record keeping and proactive compliance measures. For example, one of my longtime clients was audited not once, but twice over a 5-year span. Each time, his meticulous documentation and prompt response not only cleared him of any wrongdoing, but also earned him commendations from his advisor for his exemplary record keeping. His story is a testament to the fact that while audits are nerve-wracking, they can be navigated successfully when you're prepared. I also want to talk about a tool that many overlook: automation. In today's digital age, there are countless software solutions designed to help you manage your finances and stay compliant with tax laws. Tools like QuickBooks, TurboTax, and specialized accounting programs can automate many of the repetitive tasks, freeing up your time to focus on strategic planning. For example, one entrepreneur I worked with set up an automated system that sent him monthly financial summaries, flagged discrepancies, and even reminded him of important deadlines. This system not only kept him compliant, but also gave him peace of mind, knowing that nothing slipped through the cracks. Now, let's put some real numbers on the table. Consider this. Missing a filing deadline for an offshore account can result in penalties that start at $10,000 and can escalate even further if left unaddressed. On the flip side, investing a few hours a month in proper compliance and record keeping can save you tens of thousands in potential fines. It's a no-brainer when you break it down. Time invested now equals money saved later. I want to share one more personal anecdote before we wrap up. A few years ago, I encountered a situation where a friend of mine, let's call him Dave, found himself on the wrong side of a minor compliance issue. Dave had been so focused on finding ways to reduce his tax liability that he neglected to double-check his documentation. When he was notified of an error, he panicked, thinking his financial future was in jeopardy. However, after spending a weekend working with his advisor, he discovered that the mistake was easily fixable, and the penalty, although inconvenient, was minimal. Dave's experience taught me that the key to overcoming compliance challenges is not to avoid them entirely, but to be ready to address them head-on, learn from them, and move forward with greater vigilance. In closing, navigating legal challenges and compliance isn't about playing it safe. It's about playing it smart. It's about knowing your obligations, preparing for the worst, and taking proactive steps to protect your financial freedom. Whether it's through digital record keeping, regular consultations with experts, or automating your financial processes, every action you take brings you one step closer to a life where taxes don't dictate your financial destiny.